All right, welcome back to the show, guys. Another episode of the Full Subjects podcast. We've got our monthly stats episode here. I'm going to be breaking down as well a segment of the Coles Notes, as well as talking about new listings, what we've seen with pricing over the first month of the year, how spring market is going, and everything in between. As always, this podcast is for informational purposes only. It doesn't constitute legal, tax, investment, financial, or any other advice. It's not intended to cause or induce breach of any existing agency agreement. It's cool that I nailed that because I don't have the script in front of me. I just realized as I popped it off, and let's get into it. Cool. Take it away.
All right, it's funny. I'm laughing still at what you said in the intro there, but I figured you had it memorized at this point. So
I do not. I'm not that good.
yeah, okay. So I'll do a quick Coles Notes market update here. So we're going to talk about rates, obviously, because that's kind of what most people are most curious about. We'll talk a little bit about rent pricing, Austin. I'll get your input on that. I'm going to kind of throw that in at the end. So let's talk about what drives prices or drives rates. Sorry. So we've talked about this before. Fixed interest rates are driven by the bond market. 5-year rates are driven by 5-year bonds. So what does that mean? What does it mean? It means that as bond yields adjust, fixed interest rates are going to adjust. And when things like tariffs come into effect, the bond market typically responds to that. So bond yields react in terms of going down when tariffs come into effect. And that's because more people start buying bonds because they go, oh shit, something's going to happen. The economy might go and get into trouble here. We need to buy something that's secure like a bond. So those bond yields are going to go down because the demand goes up. The nice thing about that is it means that fixed interest rates usually go down as well. So that's kind of how those things are tied together. And we have seen some adjustment in fixed interest rates. We've seen them come down a little bit. Now, the whole tariff thing we talked about on the other episode, it's kind of happening, but it's kind of not happening. So we're seeing tariffs right now with steel and aluminum specifically, but not broadly across all goods. We'll kind of see where things go. I think March 4th is the next major date in terms of whether or not they decide to push more tariffs. But that's not the point of this segment. So let's continue. So talking more about the US inflation went up in January, which is not a really good thing. And here's why. So US inflation going up means that they're likely not going to cut interest rates in the US further because they did cut rates and inflation went up. So they're like, okay, well, this isn't working, which means they'll probably hold rates or they might even raise the rates, which you might think, okay, that doesn't make sense, but it does because they don't want to see inflation get out of hand. So they kind of want to stop people from buying too many goods, which can cause that to happen. So why this is relevant for Canada is because Canadian economy and US economy are very interconnected. So if the Canadian economy, and in other words, if Canada continues to drop their interest rates and the US doesn't, or they raise their rates, the Canadian dollar tanks even further. So that's where it really matters, is the Canadian dollar is really hurt by the US and the Canadian banks doing different things when it comes to their interest rates. So that's not great news for Canada, especially if Canada does intend to drop their rates further. Segue into the next part. Is Canada actually going to drop their rates? That's important, right? So unemployment data in January came in higher than expected. Now we've seen stronger than expected data come in for the last few months, dating back to January. That doesn't necessarily mean we're going to see rates go up or go down. It just means that we're not very good at predicting things more than anything else. Economists, that's what they do, right? They forecast, they predict, and we're not always perfect at doing that. So unemployment rate, is still at a level that isn't great. Like it's still at over 6.5%. And I think the US, and don't quote me on this, is much lower. I think it's closer to like 4%. And I'm sorry I don't have that stat in front of me, but I know that it's lower. But what actually is causing that? So manufacturing jobs went up quite a bit in January, and this is going to tie into tariffs. Now, if we see tariffs, Austin, manufacturing is going to get hit by that pretty hard, especially now that we've seen tariffs in steel and aluminum, because there's a lot of manufacturing of steel and aluminum done in especially the eastern part of Canada. So Ontario and Quebec are the major provinces that do a lot of this manufacturing. And now if we see these tariffs, we're likely going to see people get laid off, which means some of these jobs are more than likely going to reduce. So Unfortunately, and same with the automotive industry, actually. So unfortunately, this may have a negative impact, these tariffs, and we might see unemployment rate go up further. That's all I've got for that. Last thing on that. Right now, I think we're sitting at about a 60% chance of a rate drop in March. And that's just based on what people are predicting are going to happen. Now, that fluctuates all the time, so it may or may not get higher or lower. But yeah, that's kind of where we're at in terms of rates and what's happening in that regard. But Austin, before we get into into the stats, which we usually start with listings, rent prices. So this was interesting. Rent prices were down 5% in Vancouver year over year in January. And they're expected to continue to fall. And the main reason for that is because we're seeing uncertainty in the economy and we're seeing declining international population, given that we're not, I don't want to immigrating. I was going to say importing. That's not the right word. Immigrating more people into Canada. Does that make sense to you? I guess that's a kind of a vague question, but are you seeing that? I know that you don't necessarily deal with that at that level, but maybe you have people that are looking to buy and they're like, rent prices they're still good, but maybe they're not as good as they have been.
Friend of the show, Kyle Grant, this is something that he's been kind of kicking down the door on, that he's been seeing in his neck of the woods. One of the things that he talked about when he was on is he doesn't, he really looked for market rent when he's having conversations about onboarding people into their units. He was telling us stories in the office how some people are actually electing to move on their own for the first time in a very long time, because then, if you see prices go down by 5%, he's been seeing people that are moving to different units within the same buildings that had vacancy or availability, and they're opting to move. So maybe they're getting a little bit more square footage or, a nicer place for the same amount of money, things like that. So yeah, that doesn't surprise me at all. I've kind of caught wind of some of this, and I think, it makes a lot of sense.
Yeah, no, that's really well said. I never even thought of the fact that, hey, maybe I'm paying more than I should be right now.
Yeah.
Maybe I can get it, right?
For the first time in a very long time, what Kyle has said is he's seeing people electing to move when their term is up, as opposed to, having to be given notice to leave, which is pretty wild to say out loud. So.
Yeah, no, and I mean, I don't know if you talked to him about the current status of inventory in the rental market, but out of curiosity, did you talk to him about that? And if you did, where do we kind of stand? Is there still inventory? Is it pretty sparse?
Yeah, not like specifically, I guess I would say, but yeah, he's said that there definitely is some inventory to choose from, just like there is on the housing front. I wouldn't say that they're direct comparables, but yeah, definitely some inventory.
That's good. I mean, that's good for people that are renting, ultimately. Maybe it's not good for people that are trying to rent their places, but at the end of the day, if you offer a place at a fair price, like when it comes to real estate and the right person is interested, there's a good chance you're going to find a tenant for it. So, but anyways, that's all I've got today for our market update. Let's jump right into stats. Ready to go?
Let's hop into stats.
All right. So we always start with listings. New listings skyrocketed in January, up 167% compared to December. Now, normally I would go, holy crap, that's a lot of new listings. But because we're comparing January to December, am I as surprised? I don't know. Should I be, Austin?
No, I think seasonally it was pretty normal. When I'm looking at the last 3 years of stats, our December was actually a little bit higher slightly. Or actually, let me pull up all property types. Yeah. So I was just looking at detached before, but yeah, inventory for new listings was actually up higher in comparison to some of the other years. And then, comparing January, there was almost 1,000 more listings in 2025 than there was in 2024. And in January of 2023, there's only about 1,586 listings. So definitely a higher amount of new listings this January compared to the last couple of years. And that came from even the December being a little bit higher than it was seasonally as well over the last couple of years too.
Yeah, well said. So comparing year over year, we're still seeing more listings. So that's good to note. Active listings are up are at a 10-year seasonal high. So that goes
Yes.
back to what you were talking about.
Yep.
And over 50% above the 10-year average. So again, that goes right back to what you said.
Yeah.
Um,
So again, for context here, guys. So in January of 2023, per the Fraser Valley Real Estate Board, and this is again just for the Fraser Valley Board, 3,300 active, 37 active listings in 2023. In January 2024, there were 3,862, and then in January of 2025, there was almost 6,000 new listings, so 5,000 or 5,929. Yeah.
double from 2 years previous. That's crazy.
A lot of inventory, a lot to choose from.
Yeah, that's great. Now let's talk about if these places are selling. So transactions. So we saw just over 800 transactions on MLS in January, which is actually almost a 20% decrease from December, which you might think, what the heck? Why are less people buying in January than December? Any thoughts on that, Austin?
I think it just has to do like we started to see a really active December, really active beginning of January. I think there's just a
Mhm.
lot of uncertainty and a lot of um, hesitation to make a move right now with some of the uncertainties that are going on.
Yeah, I think that's a good point. And I wonder if there's some holiday fatigue as well. Like maybe you see more transactions in December, like earlier in December, and then you usually get a pretty quiet end of December. I mean, when the transaction actually completes is obviously it can be different, but then in January you're kind of coming out of that, I don't know, food coma, holiday coma, and maybe you're less motivated to make the transaction or make the purchase at that point. I think that does play into it at some degree. But yeah, we'll kind of see how things keep going as we go into February here.
I think obviously we're going to talk about prices, but you know what? Anecdotally, what I'm seeing in the market right now is there's just so much inventory. There's so much to choose from. You have some stuff that's been on the market for a while. You've got some newer listings that are hitting. I think you just need to be really honest with yourself about pricing, knowing that, yeah, you might not be selling for that same number that I was talking to you about, you know, in December or even early January, just with what we've seen with prices and what we've seen with the amounts of inventory, just simple supply and demand. But with that much more supply, you know, if you're taking 25 or 50 grand less, depending on what you're selling on your sale, you could probably do better than that on your purchase with the amount of inventory and stuff that's out there.
Yeah, really, really well said. You got to look at both sides of the transaction, assuming you're looking to buy and sell. But yeah, no, I think that's really well said. So sales to active listings ratio was way down. It went down to 11%, which is 5% lower than December. And now we're back into what's considered a buyer's market. And that's not surprising based on the numbers that we were just talking about. There was a lot less sales, a lot more listings. That's going to push that ratio lower. And like Austin just said, there's lots of inventory to choose from. And it's a good time if you're looking to buy for the first time because you don't have to worry about the sales side and you're more likely going to find something that you want at a price point that is better than it has been in the past.
Very
Agreed?
well. Very well. Yeah.
Austin's nodding to me here.
Cool. Yeah. Good thing this is a audio medium, not a visual one. Well, I guess
No,
it's both, but most people listening on podcasts, it's like he's just sitting there saying nothing. No, I think that's really well said. Like if you're doing two transactions, you have with that much supply, you know, we have people right now that are wanting to go subject to sale. And obviously a subject to sale offer can be a really great offer. If you don't have an offer, like it's an offer, it's a bite, but you got to be really honest with yourself on what you're listing for. Like it's really tough to try and get quote unquote top dollar when you need to sell quickly if you're worried about getting bumped. And then also too, if there is a change in the market, like we see, you know, nearly double the listings from the year before and we have more inventory, like simple supply and demand, you're probably going to be, you know, you're anchoring yourself at a certain price when, you know, we saw prices like HPI price go down. I believe across the board last month. Yeah, slightly. But yeah, let's hop into prices and we can break that down more.
Yeah, so prices, I mean they did go down. They were fairly steady like month over month from what I was looking at. Now what we have to note here though is that 9 months prior, like the previous 9 months, we saw prices come down. So holding steady can mean a few different things. It can mean, oh, maybe we're now turning the corner. It can also just mean that month over month we didn't see much change, but we're still trending down overall. So detached, from what I saw, and Austin, I hope I'm correct on this, was actually up 0.1%, which to me means absolutely nothing. It means that basically detached prices didn't change month over month. Townhomes down 0.2%. Again, not a big change. And then apartments up 0.1. So really across the board, I think the easiest way to summarize this is prices didn't really change. And where will prices go next month? We'll tune in. We'll definitely fill you in on that. But yeah, is there anything else you wanted to add about pricing?
No, I think I feel like I've already rambled on about it. Yeah, you just got to be really, really strategic and use the other sales that are in the area when you're pricing your home effectively. And quite frankly, if you want to move, I feel like you need to either be listing right at the other one, hoping that you match for the comparable, or even going in slightly under it.
Yeah, let's talk about something really quickly. And I think we talk about this a lot, but I don't know if we've really delve deeper into this. And it's what you just said. It's make sure you're pricing your home based on comparables in the area. So here's how I interpret that. And then I want to hear the real reason for this. So I'm somebody looking to sell my house, and somebody's trying to buy my house. So my realtor, Austin, he's going to look at comparables, and he's going to go, okay, based on these comparables, this is what I think your house should be listed for. And we'll probably be able to sell it in this range. And we want to list at a price that will get people interested in the house. But then from the buying perspective, they're also working with a realtor. And that realtor is going to look up the houses in the area, and they're going to go, what did they sell for?
They're going to use the exact same data that I did.
And that's the point I'm trying to make here, is that people don't understand that we're using the same information to come to the same result. So if you think that you know something that they don't, it doesn't matter, because at the end of the day, that is the data. And is that fair to say, Austin?
No, I think that's really, really well put. Like, I call negotiating like a who's more right conversation. When I'm writing offers for clients, I'm showing them the work of, okay, this is what's sold in the area. These are your comparable homes. This is what they sold for. These are the pros and cons for this one. So, if you had a listing and another one sold in the same subdivision, and it was completely original, and it sold for, X price, and you're renovated, and you've got upgrades, you've redone flooring, you've redone the kitchen. Okay, what are the costs of that, and how does that compare to the one that sold that was original? You do all that math and say, okay, just because you did a $300,000 renovation doesn't necessarily mean you're worth $300,000 more. But all of that comes into being directive with, okay, then I think you need to be here. And that's going to be the value. And also not just comparing to the homes that have sold in your past information, but also look at the information in the present. And what I mean by that is other stuff that's on the market is a really good indicator of the activity you're going to get. So, if you're thinking of pricing at this number, because maybe that's the number that the seller wants for whatever reason, and for that price right now on the market, you can get a 800 square foot home that's bigger, with, that has nicer finishings or has a suite in it already, or all that kind of stuff. It's like, if the superior quality home didn't sell at this number, you're probably also not going to sell at that number. If, you have qualities that, aren't superior to that. Like, what's currently listed can also be really valuable in seeing where you slot on the market, and leveraging yourself in that.
Yeah, no, that's really well said. Especially the fact that you got to look at the present information, because that's going to tell you more than the past, because the past is the past. And as we speak about on these episodes, especially with stats, things change so rapidly that it's hard to base entirely off of what's happened in the past.
Well, and just piggybacking off of that, when you look at HPI price seasonally, you see things go up like pretty substantially from January to February historically. Like 2022 is an exception. So HPI price for detached and attached combined went from 1.1 to 1164. So up 60 grand. That's insane. That's a lot. In January of 2023, HPI price went from 934,500 to 944,300. So 10 grand would be roughly, not a full percent, but a substantial amount. From January of 2024 to January or February of 2024, HPI price went up from 988,200, and again, this is for detached and attached combined, to $1 million even. So again, you're looking at like 1% there, basically, or roughly. In January, things stayed the same. So that tells me, and you don't get this like. When you were talking about like the peak or the low of the market, you don't know that you're out of the peak or out of the valley until you have the data that shows, okay, that's as high as things got, or that's as low as things got. You don't have that data until the information is available. And by then things have shifted, things have changed. So with that being said, if things stayed basically the same from January to February, but we had twice as much more inventory hit the market, you feel that before the data picks it up, right? So, if I'm predicting right now, what do I think HPI price is going to be for February 2025? I think things are going to be lower.
Fair enough. And we will hold Austin to that. But no, and in all seriousness, though, we'll come back, of course. I mean, we're only 2 weeks away from the end of this month already.
Yeah.
And apologies, I guess this episode is later than normal in terms of stats, but
blame Roman.
But yeah, I think that's a fair guess, and I'm curious to see what will happen as we go into the spring, whether or not it will be a spring market. I think we'll get to days on market here, but I think there's still a lot of uncertainty that's going to keep a lot of people in a holding pattern, or be a little bit more hesitant, to be honest with you.
Yeah, very well put. Anything else you want to touch on before we wrap things up here? I guess days on market.
Yeah, quick days on market. So detached went up almost a week. So now like 7 weeks on average. Average, again, we like to preface, isn't always the best indicator, but it just gives you an idea of 7 weeks is a long time. Now
2 months. 2 months is your average days on market for a detached.
Yeah. Townhouses slightly over 5 weeks, which not really a change month over month. So maybe that's good for townhouses. Apartments up to 6 weeks. Another 3 days added for month over month. So everything's taking longer to sell, basically. Townhouses still continue to be the most, I don't want to say easy to sell, but are selling at the quickest rate.
Really good, really viable product.
It's that,
to them and then also moving down to them.
Yeah, it's that middle product that a lot of people are interested in. So it makes a lot of sense. Just quick summary here, and then we'll wrap it up. So market was in a holding pattern in January. Lots of listings hit the market after the holidays. As I just mentioned, buyers are waiting patiently. They're waiting to kind of see how things play out. We did receive a rate cut at the end of January. It might help February, but at this point, I'm not sure that it will. And I think Austin would agree with me on that. I mentioned at the top of the show that we might see a rate cut in March. It's a little above 50% right now chance is what most people are predicting. And then last but not least, tariffs could have a big impact. We know that there is some tariffs put in place for steel and aluminum. That's not significant enough that it's going to completely impact the housing market to every level. But I mean, if we start seeing people in manufacturing jobs, in jobs that are impacted by this, being laid off, that could have some detrimental impacts to the economy and to the housing market as a whole. Not at the same scale that full scale tariffs would, but ultimately it would still impact overall. That's all I've got for today, guys. But Austin, anything else you want to leave us on?
No, I think that's great. Thanks for joining us for another episode, and we'll see you guys next week.